Thank you for joining us for our Pengana Diversified Private Credit Fund webinar. My name is Daniel Fahn, and I'm part of the sales and distribution team at Pengana. We launched this product in September last year to address the unique investment needs of wholesale investors by offering a range of benefits that set it apart from your traditional investment options, which we will highlight today. I'll shortly hand over to Nehemiah Richardson and Adam Rappaport. Nehemiah is the CEO of the Private Credit Fund, and Adam is the portfolio manager who's responsible for managing the liquidity and foreign currency exposures of the trust. They will provide us with an update on the portfolio, what we are offering access to, what challenges we are addressing with the product, and importantly, discuss the reasons why we feel the current opportunity is so compelling. They will be speaking for about 25 minutes, and after that, there'll be time for questions from the audience. So please enter your questions into the Q&A box, which can be accessed from the icon on your screen. I will now hand over to Nehemiah.
I guess just wanted to thank you all for your participation in this webinar this morning. Adam and I, really pleased to be able to be here to talk to you about the Diversified Private Credit Fund, and we greatly appreciate your time and attention. I hope you found this webinar to be of value to you. So just to start, I just wanted to recap a bit about who we are, meaning Pengana Credit, and what we do. So Pengana Credit was founded in May 2022 with the specific purpose of providing Australian investors with diversified access to global private credit. Now, why did we do this? It's because it's a very attractive asset class that we think should be included in all portfolios, given that it delivers very attractive risk-adjusted returns and low correlation to other asset classes. It's got low volatility. And in the US and Europe, there's a very large and diverse opportunity set that allows for really nice diversification in portfolios. And to the extent that you're also in Australian private credit, this is a very nice diversifier. Now, global private credit is not an asset class that has traditionally been widely available to Australian investors. But it is very sought after by large institutional investors, which is why you'll see the industry super funds and the future fund as examples, participating in building portfolios within the asset class. And they do so because of those attractive returns and resilience. But even at the institutional level, it can actually be difficult to get wide diversification. So to address these investment challenges, Pengana Credit partnered with Mercer to build a highly diversified master portfolio that has up to 20 top-rated managers and over 2,000 underlying loans. And that delivers a platform for us to be able to provide investors with a range of different investment solutions that are differentiated by their return objective, their risk tolerance, and their liquidity requirements. And so today, we now manage close to $400 million of capital with 4 distinct points of access, each of which solves a particular investor need. And so today, what we'll do is focus on the Diversified Private Credit Fund. And just as a recap, this fund was really built for investors that prioritize defensive accumulation and growth. So the fund targets a return of RBA plus 7 to 9% over a 5-year period, and it has a 3-year lockup period, which the reasons for which we'll cover later in the presentation. And so today, what I'll cover is just a recap of why private credit, what the current environment is for global private credit, and we think it remains extremely favorable. We'll talk about how our portfolio is positioned within the context of the market and provide some comments on performance to date and outlook. So just a recap of what we mean by global private credit. This is predominantly bilateral loans to mid-market corporates in the US and Europe, which are the largest, most mature and innovative and diverse markets for private credit. Now, the reason why this opportunity exists is because banks have exited lending to companies in the mid-market due to their ever-growing burden of regulatory restrictions. So in these markets, the banks want to do the business with these companies, but regulators don't want them using short-term deposits to fund longer-term assets because the corporate loans tend to be 3, 5, 7 years in duration. So the regulators, in order to get rid of that mismatch, have sought to make it unattractive for banks to do so by increasing the amount of capital that they actually have to hold against these types of assets, which encourages the banks to redeploy that capital into other opportunities. And so this is why they've actually exited the mid-market. It wasn't because they didn't like the risk. It was because they weren't getting the returns on capital relative to other opportunities. So as a result, what we have is a growing supply-demand imbalance that's been created by this bank withdrawal. And it's a structural dynamic that's driven the attractive characteristics. And just the left side of this slide just really shows 84% of mid-market credit being funded by fund managers and 16% by banks. And the right side is really just the illustration of the explosive growth in this asset class, really since the GFC, when the structural dynamic commenced. So if we just go to the next slide, just wanted to cover, well, why is it that investors are so attracted to the asset class? Well, it's because you get very attractive returns as a lender, because you're compensated for holding the debt to maturity, because these things don't trade. Because they don't trade, there's very low volatility in the underlying value of the assets, which is really nice, resilient, capital stable product. And so the other thing that you get is very high capital preservation characteristics, given that the focus of the lending by the managers is to get your interest payments and principal back. And so the loans come with structural protections like covenants, and the managers very closely manage the performance of every loan to ensure that they minimize the risk of loss. Now, very diversified, because there's a wide variety of strategies that you can choose from. And so this is in part why it's a really nice diversified from Australian private credit. If we just go to slide 7 quickly, just to talk about the broad opportunity set that's available that allows you to create diversity within a private credit portfolio. So the US and European markets are large markets that have very experienced managers that have long track records of success through cycles, and really across 3 main strategies. So in addition to direct lending, which is loans to mid-market companies to finance growth of those businesses, you have structured finance, which is loans to finance pools of assets. So for example, you have bank originators of loans like working capital loans for companies or residential mortgages that are funded by private credit managers. And then there's a third type of group of strategies that's called credit opportunities. And what credit opportunities funds do is they invest in senior secured loans where the counterparty or the borrower has a financing related issue that needs to be addressed, and it requires some very highly specialized skills of managers to solve. So having access to all these strategies is actually critical to maintaining resilience in a portfolio, but also providing opportunities to take advantage of market disruption that can occur through different economic cycles. And that's why we have the 3 strategies in our portfolio. And just going to the next slide, just wanted to kind of just highlight what then are the differences between sort of global private credit in US and Europe and Australia. And I think the first thing is, when you look at the slide, is just the relative size, because the US and European market for private credit's about $1.8 trillion, and it's actually growing rapidly because of the structural gap I mentioned before. The Aussie market is about 220 billion, growing also, but not at the same rate because you don't have the same structural opportunity. Secondly, in the US and Europe, you have a very wide range of strategies and diversification. So much larger portfolios. For example, a senior direct lending portfolio would of our managers at least would have a minimum of 300 to 350 individual names in the portfolio, and as wide as 1,000 names in a portfolio. You wouldn't find that in any sort of corporate lending fund in Australia. The other key difference is in Australia, the private credit is predominantly commercial property or commercial real estate, and generally in areas where banks don't have risk appetite to lend. And so for those reasons, you'll find a very different type of underlying asset and strategies within Australia than what you would actually find in global private credit. So if we go to the next slide, just to talk about a little bit about what's actually happening in the overall market for and specifically how that impacts on the global private credit markets. So the first point to make, as everybody probably already knows, the interest rate cycle is easing, as you've seen rates cut in Europe as well as in the US. And so it appears that inflation on an underlying basis is under control. And you can currently contrast this to Australia, where it doesn't yet appear to be under control, or at least the RBA rhetoric would say that it isn't. In the US, it looks as if the Fed has achieved a soft landing for the economy, but they remain very vigilant in looking at what's happening in the underlying to ensure that they don't push too hard and push the US into recession. Europe is easing itself, but the growth in Europe is quite anemic, so it's still quite risky to the downside in Europe. And then, of course, you have ongoing geopolitical risk that actually remains in the background. So given this uncertainty and risk, there's an ongoing expectation that we'll continue to see a lot of volatility in equity and credit markets. And what I'd say then is, with global private credit's focus on defensive sectors and high quality borrowers, that really provides a nice buffer and stability against market volatility in any portfolio. And so more specifically within this macro backdrop, we believe that firstly, global private credit is going to continue to see attractive opportunities across all strategies, particularly for large managers that have long track records of performance, very strong proprietary origination, because what lower interest rates do is they actually then incentivize companies to invest, and they incentivize M&A activity. And so with them more willing to invest, private credit managers, are very well placed to benefit from that increase in activity. Secondly, given the loans are floating rate, low central bank rates mean an improvement in the underlying cash flows of borrowers, which improves the credit quality and reduces lender risk. The current environment for transaction pricing and protections remains quite attractive in the core markets that our managers participate in, and the asset quality in their portfolios remains very strong. So I guess to close off on is there's a lot of attractive opportunities for specialized credit opportunities managers, because there's a large number of companies or banks who have liquidity issues that require bespoke solutions. Or there's companies who need to refinance or restructure their balance sheets because they actually had debt raised before all the interest rates went up in 2022, and they have very few options available to them to refinance. So it's a great opportunity set out there for our credit opportunities managers, which the Diversified Private Credit Fund has over a third of its investment exposed to. So we just moved to the next slide. Just wanted to really touch on the structure of the portfolio, because it's very much deliberately structured to be able to perform through any type of market environment. So the first point that I'd make is we have very experienced and proven managers that are focused on senior secured loans and defensive non-cyclical companies with strong protections, close management, and that close management of those loans, and that really underpins the resilience of the portfolio. And we also point our investment to managers who are benefiting from that supply-demand gap that I actually talked about earlier that's there because of bank withdrawal. So because private credit is illiquid in nature, you can't easily trade in and out of it. So what we've done is we've designed the portfolio to not only be stable and resilient, but also flexible enough to take advantage of relative value opportunities that may arise in volatile or dislocated markets or in other changes in market dynamics. And so with diversity, well, why is it so diverse? And with credit, you do not share in the upside the way an equity investor does. And so what we really focus on is minimizing downside, and to minimize downside, you want to be as diversified as possible. And in particular with private credit, you can't trade in and out. So the way to mitigate that risk and to mitigate loss is to diversify in a couple of different ways. The first is we are diversified across the geographies of the US and Europe because of the largest and most mature markets for private credit. They provide economic diversity at the macro and on a micro basis. There's very wide industry diversification, and there's lots of individual borrowers in our portfolio with well over 2,000. So this helps us mitigate any type of concentration and correlation risk and any reliance and exposure to any particular economy, individual manager, industry, or borrower. And then we also diversify by strategy. And that really is to diversify the risk return drivers. So for example, lending against a company's operating cash earnings versus income earned from a pool of assets. And so it's also there as well to provide flexibility through changing market environments, as I discussed before, because different types of strategies lend themselves to opportunistic lending. And so to make all that real, manager quality is very critical to realizing those benefits of diversification. So, for Australian investors, while local private credit is relatively easy to access, it's much more difficult to assess and access European and US funds, which is why we've actually partnered with Mercer. We're an investment consultant that has a very large, massive global footprint, and they have a very proven manager selection capability. So selecting the best managers, gaining access and diversifying, that's very difficult, and it's almost impossible to achieve for all but institutional size investors. And we're able to do this, or to diversify, that is, because we're able to leverage our partnership with Mercer and their global private credit research team. And that research team is solely focused on assessing and rating funds. And so they see any new funds that actually come to market, as well as all the existing ones, on an ongoing basis, and they can actually compare and contrast as part of their whole research and rating process. So leveraging their capability to get the best managers, we then ensure that we're not reliant on any single manager and their performance or business risk. And that's why we have multiple managers, so we can minimize that, as well as provide the flexibility that I talked about before. So when you put it all together, we have a very diverse portfolio that's easy to access. It's well positioned within not only the current environment, but also to be adaptive to changing market conditions and opportunity sets. And it was purposefully constructed to be able to do so. So if we go to the next slide, just to recap on how we've actually structured the portfolio to be able to do what we do. So to deliver different types of solution sets, we assign our managers to 3 different buckets, which are really the building blocks of our portfolios. This allows us to diversify within each one, and it allows us to generate attractive cash distributions while also growing and accumulating the value of the portfolio. So when you look on the left side, that's the income bucket, we call it. That's driven by cash yield. It's all senior direct lending to mid-market corporates and defensive industries. The returns are driven by cash interest, which we see monthly or quarterly, depending on the manager. And today we have 7 managers across the US and Europe with well over 1,000 individual loans in that portfolio. The balanced portfolio provides cash yield from senior direct lending, but it also has the flexibility to earn more significant returns through some flexibility to be opportunistic if markets are dislocated. And so it can earn, not just from interest payments, but equity participation and much higher interest payments in dislocated situations, which means that these funds also accumulate returns rather than just paying all of them out in cash. And then the third bucket is what we call total return. And these funds are all earning equity-like returns. So these funds don't pay interest along the way. Rather, what they do is they reinvest their returns into new opportunities. And they also get equity from borrowers as part of providing borrowers with unique capital solutions. So what they do is they accumulate returns until the end of their fund's life, when they harvest those returns and then distribute them to investors. So for a wholesale fund, in order to meet, or the Diversified Private Credit Fund, to meet the RBA plus 7 to 9% target, and also to provide the quarterly distributions in cash of 80% of the return, we invest 30% in income, 25% in balanced, and 35% in total return. And so, having access to that diversified portfolio of total return managers is what builds the super returns, whilst being able to deliver the cash yields because of the cash generated out of our income funds. And we think that's a very unique thing, to have this sort of access to those super returning funds, but actually having a really nice cash distribution along the way. Now, to bring this to life, go to the next slide. I just wanted to walk through a couple of examples of the types of investments that are made by managers in our portfolio. So we've chosen one income manager example, and we've chosen one total return manager example, and we haven't got one for balance because really they do, they participate in both types of strategies. So on this slide, so for income, remember that we're focusing on the senior direct lenders because of those defensive characteristics and because of the really nice persistent cash yield that they generate. So this example comes from one of our U.S. managers and is indicative of the kind of things that these managers actually try to achieve. So in this specific example, a private equity firm was actually looking to acquire a B2B e-commerce business in the U.S. that makes compliance signs, labels, and tags for regulatory purposes. So, for example, road rule and traffic signs, OH&S signs, you'll see like slippery when wet and the like. And so the process of this company, well, it was being sold. It was a very contested process, and the firm needed speed, certainty, and confidentiality. So what they did was they went to one of our managers, given there's a very strong historical relationship and a high degree of trust that they would deliver within the timeframes and do so confidentially. Now, from our manager's perspective, how they look at the credit. Well, firstly, leading business in its industry with a very strong market position, had a very highly diversified revenue base with top 10 customers earning less than 4%, making up less than 4% of the revenue, very strong customer retention and repeat business. Secondly, it's in a growing industry with two dynamics. One was there was a lot of aging signage out in the market that needed to be replaced. And also there was a structural shift happening at the customer base where they were shifting to online procurement, and that's why the B2B commerce platform was actually so attractive. There was also increasing regulatory requirements, so the market overall was growing from things like COVID and the subsequent OH&S regulations that followed. And then finally, very attractive, predictable cash flow profile with really nice margins, flexibility in the cost base, and minimal CapEx needs. So this is really a classic business profile for a direct lender. It's recession resistant. It's very diversified in its revenue streams, has a very strong defensible market position, attractive profit margins, predictable cash flows, perfect for underwriting a loan. And so the result of this $75 million loan against the value of the company and assets of $230 million. So a loan to value coverage of 30%, 10.5% cash interest paid on this loan, and had very strong covenant protections, notwithstanding the quality of the company and the partner. So I guess the next example is from one of our total return managers. And in this one, decided to choose a manager that is specifically focused on asset-backed lending rather than corporate lending, just as to illustrate something different. Now, within this is a good example for another structural opportunity that's emerging in asset-backed credit in the U.S. and Europe that's arisen from bank regulation. So in this example, a regional U.S. bank ran into liquidity and capital issues due to changed regulations after the failure of Silicon Valley Bank, First Republic, and Credit Suisse. So what this bank did is they invited a very small group of qualified bidders to review the purchase of some of the assets on their balance sheet because they were seeking to create liquidity and reduce capital, bolster capital, I should say. So this situation was very confidential and sensitive because if there was a leak that they were actually trying to sell assets, it could have created a big run on the bank. So bidders were chosen on the basis that they could actually keep the situation confidential and that they could act quickly. So our manager was the preferred party in this process, given that it has deep and proven expertise in asset-backed lending at large scale, had the ability to underwrite a wide variety of assets that were being offered, had a very positive reputation in the market for its capability in this area, and a very good relationship with the actual bank and all the key counterparties that had to give consent for a transaction to proceed. So from the fund manager's perspective, very diverse portfolio of high quality assets. The manager was able to cherry pick. So in other words, purchase only the assets that it actually wanted out of this pool, and had very conservative underwriting assumptions. So for every $145 of assets purchased, they paid $100. So really nice over collateralization. The end result of that, a $386 million investment. It was underwritten at an IRR of 18%, and they actually ended up realizing 29% return because they were able to beat the conservative underwritten case that they were able to achieve by providing this liquidity in this kind of very unique situation. So what I hope is that these examples help to illustrate the defensive and opportunistic characteristics that we purposely curated in our portfolio construction. It's really unique to be able to deliver access to these types of opportunities with such a wide diversification with the liquidity characteristics we have. So, for example, this 80%, quarterly yield payment of the return, and having that with top managers across our whole portfolio. So with that as an overarching summary, I'll now hand over to Adam Rappaport, our portfolio manager, who will discuss the portfolio composition and the performance today.
This slide shows the current positioning across the portfolio, which is invested across 20 underlying funds plus cash, and roughly equally across the various strategies, from the more liquid income funds, which pay the majority of their returns in distributions, through to the less liquid balanced and total return funds, which target higher returns. Another 7 to 10% is held in cash, which helps support the contingent liquidity needs of the fund. The portfolio is well diversified across geographies, with about 2/3 invested in US funds and about 1/3 invested in European funds. It's also well diversified across strategies, with the majority of exposure to direct lending and the balance split across various strategies targeting higher returns. In terms of seniority, most of the portfolio is invested in senior secured first lien loans, with about 25 to 30% invested lower down the capital stack, which is really designed to boost the total returns of the fund. On the next slide, the table at the bottom shows the fund return, which is just over 9% since inception about a year ago. You'll note the movement in the quarterly returns. So while our underlying funds are all performing at or above their target returns, there is a time lag between when capital is invested in our managers and when they report the returns they generate from those investments. Because we started investing our seed capital from June 2022, we've eliminated a significant part of the drag that would be associated with investing in the closed-end structures of total return managers. That drag is driven by the time taken for these funds to call our capital, the time it takes for them to then invest that capital, and the time it then takes for them to report the returns to us. So basically, it takes time to get fully invested and see the returns emerge, which is why we specify a 5-year rolling investment horizon. By year end, total return funds will be roughly 70% deployed, and the balance funds will be more than 80% deployed. So the portfolio returns will increase towards target levels as the money is put to work in these higher returning strategies. I'll now hand back to Nehemiah to wrap up.
So look, just to close, I just want to reiterate a few points. Firstly, the market environment remains very attractive for global private credit for a lot of the reasons I talked about at the beginning of the presentation. Secondly, our managers are performing at or above their target returns. Thirdly, our portfolio of 20 managers with over 2,000 loans in the US and Europe is very well positioned to deliver sustainable, predictable cash yields, attractive total returns, and provide defensive capital protection through market uncertainties and economic cycles. So this combination of diversification, returns, liquidity, and flexibility is very unique and is very difficult to replicate. And we're really proud to be able to make global private credit accessible to all Australian investors in this diversified fashion. So with that, we'll open it up to questions.
Thank you, gents. We have had a number of questions come in, but just as a reminder for those of you on the call, if you do have any questions, you still have time to enter them into the Q&A box on the screen. Adam, I think the first question's for you. With inflation appearing that it is looking like it's coming under control, and what we can expect to see is an interest rate easing cycle, how would this impact the fund's target returns?
Thanks, Daniel. So a few things I'd say on that. One thing is all of our managers have long track records of delivering strong returns through various economic and interest rate environments, and we're confident that will continue. Also, bear in mind that our target returns are expressed as a margin over the base rate. So falling base rates don't actually impact our ability to meet target returns. And in fact, lower rates will help improve economic growth, which then in turn helps the balance sheets of the underlying companies and their ability to repay loans. So we'd expect to see even lower loss rates, although loss rates are very low already. The last thing I'd add is currency hedging mechanism converts US and Euro returns to spreads over the RBA cash rate. So effectively, we're hedged against falls in US and Euro rates. So regardless of where rates go, we're pretty confident of achieving our target portfolio returns.
Thanks. Just following up on that, you say that the lenders can charge a premium over bank rates, like 300 to 500 basis points, but that still doesn't add up to the fund's target return of cash plus 7 to 9. How do you aim to achieve that target rate?
Sure. So again, a couple of things on that. So on the income managers, the high level of security and reliability of the direct lending strategies means that they can typically apply some limited leverage to help boost their returns. And then the 35 to 40% allocation to our total return managers, and also to some extent our balance managers, is specifically designed to provide an uplift in returns through equity upside, like the example that Nehemiah talked about in slide 13.
Fair enough. Nehemiah, the next one's for you. With 20 managers, over 2,000 underlying loans possibly growing in the portfolio, how does Pengana ensure that each manager is effectively contributing to overall performance?
Yeah. Thanks, Dan. I think so. There's a few things to say in relation to that. I guess firstly, and I touched on this before, but why diversification? This isn't diversification for diversification's sake, if you will. We're very deliberate about how we think about what managers, and working with Mercer, of course, what managers go into our portfolio. So the first thing is, with diversification, you're trying to eliminate individual manager performance risk. So we're selecting managers for resilience, flexibility to capture relative value opportunities through cycles, diversification by strategy. We're trying to minimize concentration and correlation risk within the portfolio. Okay. And so, why this is really valuable is because it's seeking to minimize performance risk of any individual manager. Now, I guess, secondly, there's a selection process and the monitoring process. So very rigorous selection process I touched on earlier, and I'll focus more on the monitoring of managers and kind of what that means in terms of how we can influence and manage performance in the portfolio. So firstly, we maintain a very regular dialogue with all of our managers regarding performance. So what's happening in the market, the lead and lagging indicators of their portfolios, and the performance metrics. With our income managers, they're all open-ended funds. So if we have any issues or concerns with any particular manager, we're actually able to redeem our capital out very easily, as well as divert new capital to other managers, to quite easily and flexibly. So it's quite simple to do from an income perspective. With total return managers, they're all closed-end funds. Okay, they're more concentrated individually. So diversification of managers and strategies within total return bucket is really critical to minimizing any type of single point performance risk or concentration risk, because by definition, they're smaller portfolios individually. So to the extent that we're unhappy with performance, there's not really much we can do outside of talk to them about those issues. And of course, having a partner like Mercer means we have a seat at the table and trying to get people to address issues if we ever solve them. Right. But at the end of the day, diversification of the strategies, the geographies, the risk return drivers in that bucket is really critical to actually minimizing any individual impact of individual performance risk. And then finally, I would just say that we also keep very close monitoring of what's happening in the market. Right. So we have a monthly formal meeting, investment meeting with Mercer, where we cover market trends that might impact performance of the portfolio, the managers, and any of their strategies. And then we think about, well, what then is the implication of what we've actually learned on our portfolio construction and performance going forward.
Thank you. Just following on that, you've touched on the criteria for selecting managers, but would you give emerging managers new opportunities, find a place for them in the portfolio, or is it only long established managers?
Yeah. So, gosh, it's an interesting question, that one. Okay, well, firstly, let's just cover, well, what do you look for in a manager? And this is where, our partnership, one of the very critical parts of our partnership with Mercer, right? Because what we're really leveraging is what they have is a very rigorous manager selection process, which really focuses on investment due diligence. So what's the quality of the team? What's the stability of the team? If there's been turnover in the team, why has there been their turnover, and what's actually then happened to the performance of the fund? Their investment process, which goes from how they source, how they manage their pipeline, how they decide on deals to allocate into their portfolio, et cetera, and a whole bunch of other, examples. They also look at the operational side, so the governance, the organizational structure, independent valuations of the portfolio, and the like. So that is a really critical piece. Okay, now why is that relevant? Because then, but the other thing you have to do, that's one. Number two, you got to look at, well, there are different structural opportunities that emerge for which strategies could be really attractive. The question is, if you look at the manager and the track record of what's been set up, you look at the strategy that they're actually deploying into, a new opportunity. The real question then becomes, if those things are tick, tick, the most important thing is it structural or is it an acute situation? So I would say for a lot of emerging opportunities, and I can tell you there's a lot of new, buzzwords coming out of private credit and lots of different firms talking about new strategies. We are very wary of participating in those unless a manager has been around a very long time, deploying the strategy and proving that they can actually deliver it. And actually, number two, that we're comfortable that this is a structural opportunity, not an acute one. Because if it's acute, it means that beautiful return today can turn into a suboptimal return tomorrow, which is why we're tilting our portfolio to things that are sustainable in nature, or the track record of the underlying manager shows you that they can deliver it through market cycles.
Thank you. Another question has come through. They really like the product, but they don't like the 3-year lockup. Is there any way that an investor could access capital earlier?
Yeah, sorry. I think, unfortunately, I think for the Diversified Private Credit Fund, no. And that's because of that portfolio rating to total return funds, which have, as I talked about before, they have these multi-year investment periods, and there's no ability to redeem your capital early out of those funds. So this lockup for this fund is really critical, given about 35-40% is in total return strategies. But I would say that the returns compensate for that illiquidity, and we do pay an 80% cash distribution, and you would not get that sort of distribution out of a total return of an investment in a closed-end fund. Okay, so I just point that out. But for anyone who's seeking access to the asset class, but would like better liquidity, we do have different access points. Right, so we have our Term Plus business, which is a term account fund, I think relevant for this 1 and 2 year money at RBA plus 3, RBA plus 365, so shorter duration, lower return, but better liquidity terms. We have our listed investment vehicle, PCX, which provides daily liquidity through the ASX. But we also have a mechanism there that every quarter we'll do a buyback of up to 5% of the units that allows people to get out of the NAV to the extent that for whatever reason it was trading at a discount to NAV. And that pays a minimum annualized distribution of 7% against the 7% of the underlying NAV. So that's a much more liquid sort of product. And then finally, we're developing a product that sort of looks like our PCX product, but is going to be unlisted, and that'll be released or launched in the first quarter of next year. We're still working through the return profile that will meet the enhanced liquidity that we would provide, because there's no way you'll get an RBA plus 7 to 8 type return target, given that it's going to have a liquidity that looks more like PCX. So I think everyone here who's interested in that can watch the space. Any thoughts anybody has, we're always very open to hearing the kinds of things that investors are looking for that might help us to design a product that has the widest appeal for what people are looking for in terms of return and liquidity.
Yeah. Last one here, pretty topical. With the US election next week and the possibility of policy shifts depending on whoever the winning candidate is, can you share your thoughts on how different policy outcomes might impact the private credit market? Specifically, are there any anticipated regulatory or economic policies that could influence the portfolio's performance, or alter the dynamics of US mid-market lending that you might be aware of?
Yeah, I'm smiling because it's just fascinating to watch what's really happening there. So I can't wait to see what happens. And being an American, it's also a bit bemusing to see what's happening in U.S. politics. But anyways, I think firstly, I would say we're not forecasters. Who knows what's going to occur? It is a fascinating situation, right? But to address the question, I guess we're really not that concerned because our portfolio has been purposefully built to be resilient through cycles. So if things get really volatile and difficult after the election, I think we should benefit from super returns and our total return and balance managers, because they're actually there to take advantage of downside and dislocation. But we still have defensiveness because we're senior secured with defensive companies that have good market positions that are not cyclical, meaning their products are relevant every day of the week. Okay, so we're not really concerned about that. On the other side, if things become more benign or are expansionary, we're going to benefit from the growth. And that really comes from improvement in credit quality, new activity, and it'll actually improve the residual equity that kind of our total return managers have in the way they deploy strategy. So we kind of feel like we're sort of agnostic because we should be able to perform, be defensive, and grow within any context. And I guess the final thing I'd say, though, and this is if we go back to that question about due diligence and why due diligence on an investment strategy is so important, and why ongoing monitoring is important. Well, we can tell you that our managers have been very acutely aware of the external environment and the trends. Okay, so they keep this in mind in their origination and assessment processes. Right? So, for example, for quite some time, they've actually been considering, the potential for increasing tariffs in China, which is, one of the things that Trump talks about if he wins. And so, what they care about is, well, how will this impact on the risk profile of the companies they are underwriting? How does this impact on the risk profile of their existing portfolios, et cetera, et cetera? Right. So it's not a static process. These things are about what are all the macro trends? How do I feed that into the way that I underwrite, price, and put protections in place for the loans that I, provide to borrowers? And, what does that do to ensure that I'm going to generate the net return and the characteristics of the asset class that we're trying to deliver to investors? That's what happens at the underlying manager level all the time. Okay, so they're not really reactionary. They are always forward-looking, and they want to minimize risk because it's all about minimizing loss because you don't get the upside. Yeah. Okay, and that's why we're kind of the election we're really agnostic to, because of how this thing's been constructed.
Thank you. In the interest of time, I'm going to wind up. Thank you for all on the call for joining us today, and for all those who submitted questions. For those that we never got to, we will get back to you directly shortly. I hope you found this useful. And if you have any questions, please reach out to Pengana or your local BDM, and a copy of the slides and this recording will be emailed to all who registered. Thank you again for attending, and have a great day.